Hello and welcome to Business Arena on TVP World. I'm your host, Marie Cato. Let's go to the business headlines of the day. Farmers across Poland took to the streets over the weekend, voicing their strong opposition to the proposed EU-Mercosur trade agreement. Their protests reflect a growing wave of discontent among European farmers, with counterparts in France and Germany expressing similar concerns about the deal's potential impact on local agriculture.
Well, despite the biting cold and falling snow, Polish farmers have taken to the streets, marching through towns to protest against the EU-Mercosur agreement. Their message was clear. The proposed trade deal threatens their livelihoods.
On December 19th or 20th, an agreement with Mercosur is to be signed. For the past 30 or even 40 years, the Amazon has been heavily deforested, and while some pesticides and herbicides are banned in the European Union, they are widely used there. Now, the EU plans to allow the import of such food, which will inevitably lead to the collapse of European agriculture.
This discontent is not isolated to Poland. Farmers in France and Germany have also staged protests, signaling a Europe-wide apprehension over the EU-Mercosur deal. In recent weeks, French farmers blocked access to the port of Bordeaux, expressing their frustration and demanding that their government oppose the deal. German farmers have organized similar demonstrations, highlighting widespread opposition among their agricultural community. Outgoing European Commissioner for Agriculture Janusz Wojciechowski spoke exclusively to Business Arena about these concerns.
Consequence of this agreement is potential increase of import from Mercosur countries valued about 2 billion euro. But in this destabilized market, it could be the problem for the farmers, and we should to hear the farmers and to take into account their voice.
The EU-Mercosur agreement aims to create a free trade zone between the European Union and 5 South American countries: Argentina, Brazil, Paraguay, Uruguay, and Bolivia. And while supporters argue that it'll open new markets and opportunities, farmers across Europe are worried about unfair competition due to differences in production costs and standards.
After years of delays, the transformation of the energy sector in Poland is finally gaining momentum. Offshore wind projects are being developed, and the country is working to build its first nuclear power plant, with talks about a second.
Work on the first Polish nuclear plant has barely begun, but the government in Warsaw is already thinking about the second one. Not much is known at this stage, but a big reveal can be expected at the end of November, when the Ministry of Industry publishes its updated nuclear strategy. The document will contain a short list of possible locations for the second plant. Some government officials have been saying recently that a second location should be built where there are currently coal mines. Now, this could include Bełchatów, the biggest power plant in Poland, which is fueled by lignite. Members of the plant's trade unions recently made an appeal to the Prime Minister that Bełchatów should have priority when it comes to locations for a second nuclear facility. Once the power plant is closed, they argued, the regional economy will collapse. The new strategy will also include criteria for selecting a technology partner for the new plant. The usual suspects are at play: the United States, France, and South Korea. The American company Westinghouse is currently supplying the tech for the first nuclear plant, and they already made an early sales call, claiming that the next reactors could be up to 20% cheaper should Poland choose Westinghouse again. However, the most important question is still open: financing. Polish Prime Minister Donald Tusk said recently that instead of paying for most of the plant itself, the government will be looking for a partner that'll cover some of the costs. If all goes well, the second plant could be finished by 2039.
And today we will examine the challenges impacting the Polish nuclear energy industry. The clean energy transition is gaining some momentum in recent weeks, but has a long way to go before it becomes anything close to reality. Join us on The Bottom Line to find out more, coming up right after the news. Billionaire Rovan Veks, one of the richest men in the Czech Republic, might soon lose over €500 million. The court in Cyprus has ordered his company, CPI Property Group, to pay out a sizable penalty to 2 men he allegedly conned.
This is Rovan Veks, majority owner in the CPI Property Group, a major real estate holding company worth some 20 billion euros. The company is preparing to comply with a court order by separating assets worth 537 million euros from its real estate portfolio. The Cypriot court ordered these assets to be frozen after a ruling stating that Veks owes the money to two men who sued him. The men in question, Marek Chmejla and Jiří Diviš, sued Veks, alleging they lent him money for joint investments, but were later cut off from the assets Veks purchased using their funds. Their cases were dismissed by courts in the Czech Republic, Luxembourg, and the US until the fourth country, Cyprus, ruled in their favor. Veks denies these allegations. His defense points out that the pair have been convicted of money laundering by a Swiss court. The accusers also say that their conviction was the reason why their deal with Veks was secretive and difficult to prove. The CPI Property Group claims it can easily comply with the order without significantly hurting its liquidity. The group has been ordered to separate relevant assets by early December. The appeal process could take 2 years to complete.
And in the macro world, we have the recently rare opportunity to start the week with a pleasant surprise for a change. Industrial production in Poland has come out way above expectations.
Poland's industrial sector has finally surprised observers. In October, industrial production significantly exceeded economists' expectations. The value of sold production of Polish industry in October 2024 was 4.7% higher than in the same period last year. Statistics Poland reported, and month-on-month, we saw a double-digit increase of 10% compared to the projected 6.5%.
It was a big positive surprise. I think the first one from industry in months, I think, because we're on the tail end of a long series of disappointments there.
If we look at the results from past years, we can see that Polish industry has been suffering from stagnation since early 2022, when it began its downward slide, finally reaching a low of negative 6.4% in May of last year. It's been oscillating around the zero mark since then. So is it too early to talk of a rebound? Piotr Bartkiewicz from PKO Bank thinks so.
Although, as good as this print has been, I think there might be some doubts regarding what actually caused it, because if you look at, for instance, how well our trade partners are faring, it's too early to call it a major recovery.
Poland's economy isn't exactly booming right now, and its neighbors certainly aren't driving demand. Poland's major trading partner, Germany, is on the verge of a recession, so there's still a high likelihood of some one-off statistical effect here that has boosted this figure artificially.
Nevertheless, the fourth quarter is starting on a positive note, so I think that we should still celebrate this.
Well, fingers crossed we'll get confirmation of these figures and a possible trend when November's results are published next month.
And that's all for our business news updates today. For more business stories, check out tvpworld.com.